For much of the past decade, growth became the dominant obsession in American business. Companies were encouraged to expand as fast as possible, capture market share aggressively, and worry about profitability later. Revenue growth, user growth, store growth, and geographic expansion were often treated as proof of success, even when losses were mounting underneath the surface. As long as growth charts pointed upward, many businesses were rewarded by investors, lenders, and the media. That mindset shaped corporate strategy across industries. Today, that era is clearly ending. American businesses are making a decisive shift away from growth at all costs and toward profit discipline, and this change is redefining how companies plan, operate, and compete for the long term. The roots of growth at all costs lie in years of cheap capital. Low interest rates and abundant investment funding reduced the immediate consequences of losses. Companies could borrow cheaply, raise money easily, and delay profitability while pursuing scale. Long-term plans were often built on the assumption that capital would remain accessible and forgiving. Growth itself became the strategy, with profitability framed as something that would naturally follow once scale was achieved. As financial conditions tightened, that assumption began to break down. Higher interest rates and tighter capital markets exposed the risks of growth-first strategies. Losses became more expensive to finance. Investors became less willing to subsidize unprofitable expansion. Companies that lacked clear paths to sustainable margins found themselves under pressure to change quickly. This shift forced leadership teams to reevaluate what growth actually meant, and whether it was creating lasting value or simply increasing complexity and risk. One of the most visible signs of this transition is how success is now measured inside organizations. Growth alone is no longer enough to justify decisions. Executives are being asked to explain margins, unit economics, cash flow, and return on investment. Businesses are scrutinizing whether each product, customer segment, or expansion effort contributes positively to profitability. This has changed how strategies are designed and how performance is evaluated at every level of the company. Cost discipline has become a central priority. During the growth at all costs era, inefficiencies were often tolerated in the name of speed. Marketing budgets expanded rapidly, headcount grew aggressively, and operational complexity increased as companies chased scale. Today, those same areas are under close review. Businesses are identifying redundant processes, trimming unnecessary spending, and simplifying operations. Cost control is no longer viewed as a defensive move, but as a strategic advantage that supports long-term stability. Hiring strategies clearly reflect this new mindset. Instead of expanding teams as quickly as possible, companies are focusing on productivity, skill alignment, and output per employee. Long-term workforce planning emphasizes efficiency and effectiveness, rather than sheer size. Organizations are investing more in training, clearer role definitions, and better performance management. The goal is to build leaner teams that can deliver consistent results without constant expansion. Product strategy has undergone a similar transformation. Growth at all costs often led to bloated product portfolios as companies tried to appeal to every possible customer. Over time, this approach increased costs, strained operations, and diluted focus. Profit discipline is reversing that trend. Businesses are cutting underperforming products, narrowing their offerings, and concentrating resources on areas with strong margins and reliable demand. Simplicity is becoming a competitive strength rather than a limitation. Marketing and customer acquisition strategies have also changed. Instead of spending heavily to acquire customers at any cost, companies are paying closer attention to customer lifetime value and profitability. Long-term plans now prioritize retention, pricing discipline, and sustainable demand over short-term growth spikes. Marketing budgets are being optimized to focus on high-quality customers rather than maximum volume. Capital allocation decisions reveal how deeply this shift has taken hold. Large speculative investments that once made sense in a growth-first environment are now harder to justify. Businesses are prioritizing projects that improve efficiency, strengthen core capabilities, or deliver predictable returns. Expansion still happens, but it is paced, measured, and closely tied to financial performance. Growth is treated as a result of strong fundamentals rather than the primary objective. Technology investment provides another clear example. In the past, companies often invested heavily in technology based on future potential alone. Today, technology spending is expected to deliver measurable outcomes. Long-term technology plans focus on systems that reduce costs, improve visibility, support better decision-making, and enhance operational efficiency. Technology is increasingly seen as a tool for profit discipline, rather than a gamble on growth. This shift has also reshaped how companies communicate with investors. Growth narratives built on ambition and scale are being replaced by stories centered on execution, margins, and resilience. Investors are rewarding businesses that demonstrate discipline, transparency, and realistic planning. Long-term guidance emphasizes sustainability rather than aggressive expansion targets. Credibility has become more valuable than bold promises. Risk tolerance has declined as well. Growth at all cost strategies often involved accepting significant financial and operational risks. Profit discipline encourages a more cautious approach. Companies are stress-testing assumptions, building buffers, and preparing for slower growth scenarios. Long-term planning now accounts for economic volatility instead of assuming continuous expansion. Importantly, this shift does not mean American businesses are abandoning growth altogether. Growth remains essential, but it is being redefined. Profitable growth, efficient growth, and resilient growth are replacing speed-driven expansion. Companies are learning that slower, disciplined growth often leads to stronger long-term outcomes than rapid but fragile expansion. This transition is also influencing corporate culture. Teams are being encouraged to think beyond growth metrics and consider long-term value creation. Accountability is increasing, and decisions are evaluated based on their financial impact over time. Profit discipline fosters clearer priorities, better execution, and stronger alignment across organizations. Across the US business landscape, the move away from growth at all costs reflects a broader maturation of strategy. Companies are adapting to an environment where capital has a real cost and uncertainty is constant. Growth without discipline is no longer sustainable. Profitability, efficiency, and resilience are becoming the true measures of success. The shift from growth at all costs to profit discipline is not a temporary correction. It represents a lasting change in how American businesses operate and plan for the future. By focusing on margins, efficiency, and sustainable value creation, companies are building foundations designed to endure. In a more demanding economic environment, profit discipline is no longer optional. It is the cornerstone of long-term success.